head across to FIIG Securities. Stephen Nash is standing by and he's going to take us through a whole bunch of stuff. Stephen, I want to start with something that happened yesterday and get us, if you can, to explain what it means and what sort of questions your clients are asking you. The inverted relationship between Australian government bond yields and the cash rate doesn't happen very often. What does it mean?
Well, what's happening is that expectations of growth are being lowered by falls in equity markets, and that means lower inflation. So yields are anticipating some sort of easing. I think at the moment what we're going through is a bit of a preview of probably what will happen in 2012. We expect at this stage that US growth will lift towards the second half, putting focus back on the RBA to tighten one more time, and we imagine that rates will rise into that. But essentially what we're getting is a bit of a preview of what will happen in 2012, probably towards the end of that year. So people have been inquiring quite a bit about, is this the time to lock in rates?
Yeah.
We would say, well, you're probably going to get better levels in the next few months.
The market's pricing in, is it right that the market is now pricing in cuts before a rise though?
At the moment, yes, the market does a lot of things. It moves quite, it can get a bit carried away. If you look at the history of what the 3-year bond versus the cash rate, it's quite volatile, and the market builds a lot of expectations in. So, sometimes they're right, but a lot of the time they're not.
So is there's still a place, is there still good buying in fixed income?
Look, I think the argument for fixed income is very solid. A recent report out by the OECD mentioned that bonds are the dominant asset class for the OECD. Not the case in Australia, however, with one of the highest equity weightings in the OECD, also a very large pension market. So essentially our market is a quite risky market. If you put the size of the market together with the equity allocation, indicates we've got a very risky market here. I think, as I said, I think this is a bit of a preview of what's going to happen next year. So the argument for fixed income is pretty strong, and people should just be looking at what have I got in equities and trying to diversify into some quite high-yielding bonds. I mean, you can get quite good yields and you can cut your portfolio risk dramatically without cutting return much by adding bonds. Yeah.
Let's have a look at the Australian economy. We've got a whole bunch of data out in recent days. What are you taking from it and plugging into your modelling, I suppose? I mean, we've got house prices, building approvals, we had the TD inflation gauge, retail sales numbers. If you put it all together, what's it telling you?
Well, we've got, I think, a very conservative consumer. That theme just keeps on running all the time. I think you've heard that many times. You're probably getting sick of that term right now. Also, I think the issue of inflation is just something that's just not going away right now. Productivity is just not high enough, and that is leading to this elevation in inflation, which the RBA is really concerned about. They said that they were concerned about it in the May statement. They were particularly concerned about the underlying measures going up. That continued in June. Now, it's evident that the RBA will be focusing on that in the next few months, and I imagine that when we have some of the issues bedded down in the US and growth returns in the US, we'll get that focus back on inflation and the delivery of a tightening, possibly around November, maybe December this year.
Okay, let's turn to the US, because I'm keen to know what you're watching there, what you're thinking about the situation. We've obviously had the debt deal done.
Yeah.
The ratings agencies have, for the large part, kept their AAA ratings with a negative outlook. We're still waiting on S&P.
Yeah.
What are you expecting to play out there?
Look, I think it was quite significant that Moody's came out and did their affirmation of the AAA rating. They are the dominant agency in the US. That's quite significant. However, the problem for the US is growth. As I said, we'll get increased growth, but the problem is for the US that growth is not enough to reduce the unemployment rate. They need policy measures to tackle that. I think also what's happened in the first half is that we've had activity depressed by high oil price, which has gone away, or to some extent. Also, Japanese earthquake disruptions have interrupted production. Going forward, I think that the effects of the debt ceiling have also depressed consumer sentiment quite a bit. So now that's passed, I imagine we'll get a lift in production towards the second half, but then there need to be additional measures to stimulate employment growth. Otherwise, we're going to be with 9% unemployment for the next few years.
Well, that's the conundrum, though, isn't it? I mean, they're now talking about some further form of stimulus, some other form of, you know, a QE3, but
yeah.
How? I mean, how can they? Where's the money going to come from to stimulate the economy when they've got no money?
Look, there's got to be I suppose, what they call an effectiveness audit of what the government is doing in terms of delivering services. Got to save money there. There could be moves to extend payroll tax incentives. Also, spending on infrastructure, I think that's an area that could be looked at in more detail. There may be some moves to moderate pay increases in the public sector. I think any change in wages for the public sector will send a signal back to the Fed that wages are under control. To the private sector, I think that could be something that could be explored. But the problem is that all the policy number crunching power has been looked at, has been directed at the ceiling for the time being and not on the main issue, which is employment. And I think that's going to happen in the next few months.
All right. Stephen Nash, thank you.